Welcome to Yahoo Finance Live. I'm Shauna Smith along with Akiko Fujita. And let's get you up to speed with an hour to go in the trading day. We certainly are looking at a very different market move than what we were looking at this morning shortly after the open. Now, all three of the major averages are in the red. We're trading right around the lows of the session with the Dow off 264 points, S&P off nearly 1%, the Nasdaq the biggest decliner of the three. Investors digesting a number of headlines coming out from Fed officials, including Boston Fed President Susan Collins, who told Yahoo Finance earlier today that more rate hikes may be needed. And Akiko, when you take a look at the red that's on the screen, it really seems to be that investors are looking past what we thought was going to be the biggest story here for the markets as we started today. And that, of course, was the blowout report that we got from Nvidia last night.
Yeah, it has been an incredible run for Nvidia. The upside continuing today with shares of Nvidia moving higher after another monster quarter. You see the stock up more than 2% there right now. An outlook for the company also on the back of strong demand, also helping lift the stock, especially around the outlook on AI chips. Net sales surged 101% from the prior year to $13.5 billion. Earnings per share improved a staggering 429% year on year. We saw the huge move to the upside on the back of the report yesterday and after hours results. Shauna, but it's been interesting to me to look at some of their competitors and how the other semiconductor chip makers have been moving today, moving to the downside, partly because of what I think is still an incredible number. Nvidia, with roughly 90% market share for AI-related GPUs. And when you think about what really led to the upside in the stock, obviously a lot riding on just the sheer amount of revenue coming from that alone. The revenue from data centers, which is where the AI concentration is, grew 171% to $10.3 billion. We've seen a number of analysts weigh in today, Shauna, all, of course, moving to the upside. And it feels like it really is about how quickly the company can churn out these chips. That really the only thing that could slow it down, or at least it seems today.
Yeah, exactly. And Akiko, that was one of the concerns that analysts had going into the earnings call last night, whether or not Nvidia was going to keep up with that demand, given the fact that there has been some talk about potential supply issues going forward. But largely when you take a look at what the street's reaction was to that call this morning, Nvidia did a very good job of kind of addressing some of those fears, saying that they are still in a very good position. They've made a lot of moves in order to secure some of that extra product that they need, the demand to meet that demand here going into the end of the year and, of course, into 2024. The street is very impressed, and CFRA's Angelo Zeno, he joined us on the show shortly after the earnings results broke yesterday, and he simply put it that it was just a fantastic quarter. And you talk about the fact that data center revenue up 170% from just a year ago, and the fact that we are seeing Nvidia still up over 2% today, while many of its competitors are in the red, just really speaks to the fact that they have such a first mover advantage when it comes to this space. And yes, of course, some of their competitors will eventually and will benefit. They are benefiting now from the shift to AI and the spending that we're seeing on AI. But Nvidia by far the leader. We're looking at the excitement in the stock today, and of course, we've seen it since the start of the year.
Yeah, no question about that. On the supply issue specifically, Shauna, you talk about the concerns that were there going into it. Keybank's John Vin saying, to your point, that Nvidia gave a lot more transparency here, saying the visibility extending into 24. Management has qualified additional suppliers. They're able to meet that demand, expects to increase supply each quarter through next year to meet that demand. So, I mean, we can go through a long list of upgrades that came through, but certainly it feels like Nvidia is running on all cylinders today, off of the highs of the day, but still up more than 2%. Well, the other big story for Wall Street today is the Federal Reserve. Chair Jerome Powell set to speak tomorrow morning in Jackson Hole. In an exclusive interview today, though, Boston Fed President Susan Collins told Yahoo Finance that more rate hikes could be on the way. Yahoo Finance's Jen Schonberger joins us now from Jackson Hole. Jen, we see the market sort of moving on the back of those comments in your conversation with the Boston Fed president.
Good afternoon, Akiko. That's right. In an exclusive interview with Boston Fed President Susan Collins here in Jackson Hole on the sidelines of the Kansas City Federal Reserve's annual economic symposium, she told me that the Federal Reserve may need to do additional rate hikes and is looking to hold rates at heightened levels for an extended period of time, even if the Fed decides against increases later this fall. Take a listen.
Until we're actually at each decision point and we have all the data in hand that we're going to have, I don't think it's helpful to say a preset path. We may need additional increments, and we may be very near a place where we can hold for a substantial amount of time.
Collins telling me that it's premature to determine exactly where the peak is on interest rates, noting only that the Fed may need to do additional increases. The Fed put forth 2 more interest rate projections at their June policy meeting, one of which was executed in July, leaving 1 more on the table. Officials are expected to put forth new interest rate projections at their September meeting. Collins, for her part, says she wants to be patient. She doesn't want to get ahead of the data. So she says she needs to really see supply and demand come back into better balance on a sustainable basis for inflation to really come back down to the central bank's 2% target. Now, Collins' comments coming just ahead of Fed Chair Jay Powell's major policy speech here tomorrow morning in Jackson Hole. Back to you.
Okay, Jen Schonberger live on the ground for us there in Jackson Hole. Looking forward to your coverage all day on Friday as well.
Nvidia shares pushing to the upside today, hitting another record high, now up just about 2% following its blowout second quarter results. Revenue surging to an all-time high, up 101% from just a year ago. Here with more on what this means for the broader market, we want to bring in Reese Williams, a Spouting Rock Asset Management Chief Strategist. Reese, it's good to see you. So the rally that we saw earlier today in many of the tech names, that rally, of course, has fizzled out. Why do you think that is? Is a lot of this hype surrounding AI and Nvidia already priced into the market?
Well, I can say that the AI is probably not priced in. I mean, obviously, Nvidia just raised guidance by $3 billion, which was already aggressive guide to begin with. So I think the AI story is terrific right now. I think the problem with tech is that it's sort of sucking up all the money in the IT spending budget. And I think in general, and the reason why, tech is going to sold off a little bit here recently in the last couple of months is that the IT budgets outside of AI are a bit constrained right now. I think there's some hope that we're getting near the end of that. That's the trouble.
Yeah, and that appears to be the concern if outside of Nvidia, where there's a lot of investments going into AI, but maybe that's taking some money away from some of the other tech investments. For those investors who are watching this incredible run from Nvidia who aren't in it yet, I mean, have they basically missed the boat, or do you still get in on this name, knowing that there's still a lot more runway based on what we heard from the company?
Well, we own Nvidia, and so I can't give you an official buy or sell decision today, but I would say this is one over the long term you really want to own. It's the leader in this space. AI, I believe, is the most dynamic, theme over the last 20 years. I think it rivals what went on the internet, and I think it's going to be the single biggest thing that improves productivity in the United States over the next 5 to 10 years. So I don't think it's in the 9th inning of AI. After all, nobody had ever heard of AI in January. I think we're still pretty early, and Nvidia is going to be the Pied Piper of AI.
Reese, there certainly seems to be at least some risk, some worry in the market today. We're looking at all 3 of the major averages trading to the downside, and we've certainly seen some pressure across equities over the last couple of weeks as we've seen the surge in yields. How are you looking at that move that we've seen higher in yields and what that poses, what that means here for the broader market?
Well, I think that's been a huge problem for the market in the very near term. And I also believe that now with China sort of rolling over, and that's causing Europe to roll over a bit, I do think there's going to be less pressure on yields going forward. So my guess is yields sort of peak out close to 4.5% on the 10-year, and at that price, things will really start to slow in the U.S. Despite the heavy Fed issuance and the QT, which has also been part of the problem with yields rising.
So when you look at where you should be positioning yourself, is the biggest risk still the central bank? Is it China? I mean, what are the key risks you're watching out for right now?
I expect Chairman Powell to not give the Clint Eastwood "Make My Day" speech, which is what he did last year, tomorrow. I think he's going to say, we've done a lot. We're moving in a good place. The CPI is going in a direction that we like, though he's going to say higher for longer in terms of keeping rates higher. But I'm not at the camp that the Boston Fed Reserve Chairman will carry the day in the overall Fed committee. So I expect tomorrow's speech to be somewhat uneventful, actually. But I think clearly there's some cross currents out there. But if the next couple months CPI prints come in at a good level, and I think they will, I think there's going to be something with a 2 in it over the next couple months. I think that's going to keep the markets in an okay place. So we're not aggressive buyers here. I do think that there's also very little chance of a real meltdown like we had last year.
Reese, do you think policy is tight enough right now to get to that 2%? Do you think 2% should still be the target?
That's an interesting question, Shauna. I think long term that might be a hard target to pull off. I think in the short term it will, because don't forget you have rent is 25%, and rent is facing the CPI, and rent is facing seriously difficult comparisons, and so therefore the number is going to look pretty good here for the next month or two. I think as we get into the first quarter, you start easing some of these compares, and inflation might head back to that 3 to 4 level. But that's, by the way, is exactly why AI is so important over the next 5 to 10 years for the U.S. economy, because we need to figure out how to make workers more productive in a demographically short world.
So where else are you seeing value right now outside of tech? Where are you putting your money?
Well, I think a barbell approach makes some sense. We like big tech. Also, there's some cost-cutting stories there too, which helps in a difficult environment. But on the kind of more value-y side, we think energy looks interesting. It's started to perform a little bit, but it's been the worst performing sector this year. And we think that the Saudis have defended $75 oil. They've decided that is the point where they will unilaterally cut. So I think you have somewhat of a Saudi put. And at even with the Chinese demand being worse than people thought, given the recovery story, there's a very good normal steady state oil usage as people drive cars, and not everybody has an EV car in China. And so therefore, the fact that China is more mobile this year than last year is going to keep oil demand okay, we believe. So we like the supply-demand balance in oil. The other thing to think about is U.S. E&P companies have just had to cut a lot of dividends. Special dividends, because the price has gone down. I think they're going to be very reluctant to ramp up CapEx to chase higher oil prices. So we think oil prices should be pretty good here in the near term, and most of these companies have pretty good dividends.
Reese Williams, good to talk to you today. Appreciate the time.
Nice.
We're just getting started here on Yahoo Finance Live. Coming up, Republican presidential candidates square off without former President Trump in their first debate for the 2024 nomination. We're going to break down the biggest takeaways from last night on the other side. Plus, a major retail deal as Shein partners with Forever 21 owner Smart Group Holdings. More on what the deal means for the online shopping industry later in the hour. And shares of online mortgage lender Better plummeting today after its public debut on the Nasdaq this morning. We're going to speak to the CFO in the 4 o'clock hour. Stay tuned. Much more here on Yahoo Finance Live.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings. And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
All eyes are on Atlanta's Fulton County Jail today as former President Trump is expected to surrender. He faces 13 counts related to his alleged efforts to overturn results of the 2020 election in Georgia. He's the first former president to face criminal charges. Now, that comes one day after GOP presidential candidates squared off without Trump in their first televised debate. Opponents were asked if they would still support Trump as a nominee. If he's convicted of a crime, almost all of them said yes. Joining us now is James Carville, political strategist and host of the Politics War Room podcast. James, I'm curious to get your take on the first GOP presidential debate here. Vivek Ramaswamy getting a lot of high praise, at least in terms of his performance on a national stage. What did you think?
Well, I have a simple rule that never fails me. When I watch a Republican debate, I ask myself who irritated me the most, and then I declare that person winner. Okay, so Ramaswamy is the Herman Cain, Michelle Bachmann of this cycle. I mean, he's everything the media loves. He's a Harvard graduate. He's a tech bro. His name is hard to pronounce. They can't stop slobbering all over it. He 9/11 truther. The guy has something going to cut 75% of government spending. And I'm sitting here in South Louisiana, South Mississippi, where I had 3 weeks of 100-degree weather, and he says it's all a hoax. How can you beat this guy? He's hit a triple with the press, but I can assure you he's going nowhere.
James, do you think he could be a real challenger to Trump, who is still by far in the polls, despite 4 indictments, is leading by a massive margin?
No. I mean, Michelle Bachmann and Herman Cain, in the end, going to fizzle out. This guy's positions are on the other side of insane. And yet he's kind of different. And, he interrupts people. He talks loud. He says a lot of idiotic things, which, to Trump people is kind of attractive. But his best message is, I will pardon Trump on day one. And that's what's going to keep him kind of above water here for the foreseeable future.
James, we were just showing which candidates are leading right under the former president. There's not a lot of talk about the number 2 here, Ron DeSantis, based on his performance yesterday. I mean, why do you think he's just not getting traction, at least within the Republican Party?
Well, Ron DeSantis made a huge bet. This is Yahoo Finance. He took a strong position, and he went long on woke. And woke wasn't even mentioned until minute 90 last night. So he got in early on a turkey of a stock, and he doesn't know how to sell it. And if you stop and you think of this, every other word out of his mouth was woke this and woke corporations and I don't know, woke bathrooms or woke whatever. And now the whole thing is kind of petered out on him. So he's stuck with a long position in an underperforming asset, to put it in your words.
James, do you think he can win back support, and what does he need to do?
Well, I mean, look, anybody can do anything because Trump is severely overweight. I think he's going to win at over 277 tonight in the Fulton jail. He's under enormous stress. He's already fantasizing about leaving the country or whatever. If you watched him on Tucker Carlson last night, he was talking about how Jeffrey Epstein had multiple beautiful homes and he committed suicide because he was incarcerated. You can assume what's on Trump's mind right now. So if that collapses, Ramaswamy has one strength is he's not attacked Trump, which means a lot to the Trump people. I mean, Ramaswamy, well, DeSantis, they're not going to like him because he attacks Trump. But if Trump does end up not able to run, which is, I don't know, it's a distinct possibility, but it's somewhat of a possibility, it'll be, start over again. And I guess he would, he's got some money, he's got some rich backers. He shakes his lobbyists in Tallahassee down for tens of millions of dollars. So you can't discount him, but he got, like I say, got stuck with a long position in a really crappy stock.
There were a lot of mentions of Bidenomics in that debate last night. This is a term that the White House has really sort of turned upside its head. For a while, they didn't want to use the term. Since then, we have seen President Biden out in campaign mode, pushing his policies, pushing the results as he sees it. Do you think it's having some traction here? And does it make sense, or is it a good bet to double down on his economic policies?
Well, remember Obamacare. Everybody kind of resisted that. It was the Affordable Care Act. It resisted that. And the name that became part of the national, lexicon? Is that the word I'm looking for? Some fancy word like that. And I suspect, for better or worse, that they're stuck with this name. And if incomes start, which if some evidence it might be starting to do, over a period of time, exceed in the CPI, and maybe people will warm up to it. But right now, people are, whatever you call it, are not particularly warm toward this economy. But statistically, it looks pretty good to me. But when you talk to people about it, the observations are pretty negative. For President Biden's sake, I hope that turns around.
Is it still about the economy for voters? I mean, you coined the term yourself, right? It's the economy stupid. Is that still the case? You think in this very polarized environment, does the president's fortunes turn on the economy and the economic performance at the time of the election next year?
Well, I think it does turn on people's perception of the economy. I mean, there's the real economy. That's the number we get out of the Bureau of Labor Statistics, and the things that you're sitting out in Jackson Hole that y'all covering. Thank God you're a lot cooler than I am. And then there's the economy of the water cooler, and that first economy right now is profoundly outperforming the economy of the water cooler. But the water cooler will beat Jackson Hole every time. And I don't know how long. I mean, what the Biden people would say is, look, Reagan's approval was in the low 40s in August of 1983. Look, Clinton was kind of nowhere over the summer of 1995. Biden over the summer of 2011. And once things take hold, we're going to be fine. Well, certainly that's a legitimate talking point. But if they're wrong, we could be stuck with a not particularly illustrious November next year.
Political strategist James Carville, always good to get your takes. Really appreciate the time today.
You bet. Thank you. Have fun out in Jackson Hole.
Disney, one of the worst performers in the Dow today. You're looking at losses of just about 3.5%, on track to close at the lowest level since 2014. Here with a closer look at the big board, Yahoo Finance's Jared Blickery. Jared, there's a heck of a lot of red on your screen up there.
Yes, there is. This is the Dow, and some of the darkest red is some of the smaller companies now. Boeing down 4.5%, Intel down 4%, Walgreens Boots down about 3.5%, but we're talking about Disney today. Here's the intraday price action, and you can see we are just off the lows here. What caused this calamity? calamitous decline here. I'm just going to say it's technicals. We had what was a base here providing support, breached it today, and we are just heading down. And in fact, if you were to exclude the pandemic lows right here, you'd see we haven't seen these levels since about 2014, 2015. So this is some serious price action here. And for the people who have lauded the return of Bob Iger, maybe it is and will have been a great thing when we look back. So far, really not panning out, because that happened somewhere in here. November 20th was the day he took the helm back from Bob, what's the other one? Chapek? Yes, the two Bobs. And now we're $15 billion in market cap below that price. And just because we're talking about Nvidia so much today, Nvidia, by the way, over the last 2 weeks is up about one Disney, which is $150 billion. In fact, more than that. And then you take a look at some of its peers here. Let me get our streaming heat map up, and you can see it's a sea of red. AT&T up marginally because of its, well, not because of, in spite of its streaming business, but for the most part, we're seeing a lot of red on the screen today. Another stock that is on my radar is AMC. So let me get to our meme stocks here. They have had quite the run down. AMC is right here, down 25%. The APE shares are down 17% right here. And let me just show you what has happened this week. And this is all because of that share conversion, where those APE shares are going to be converted into AMC common shares. That is seen as a diluting event, but I think the shareholders are now just saying, well, this is a going concern. This is a going concern problem. The company may not stay in business. 60% down for AMC common shares, 36% down for the AMC APE units. A lot of times before, we were seeing these go in opposite directions, and that is just not the place that we're seeing right now. The convergence is to the downside. So just getting back to, I guess, one of the overall theses here today, we're seeing some stocks really just kind of fall out of bed from established positions. I mentioned Walgreens. That's a similar chart to Disney. Really not great if you're not an AI stock today. Just look at Nvidia and then everything else.
Yeah, exactly. We're seeing a lot of red for many of Nvidia's rivals today. All right, Jared, thanks. Well, coming up, a major merger could shake up the retail industry. More details on the deal between Shein and Forever 21 when we return. Shein reaching a deal with Forever 21 owner Spark Group Holdings. The fashion retailer is aiming to boost their reach with this strategic partnership. Here with the details, Yahoo Finance's Brooke DePalma. And Brooke, it's two brands that have a very loyal and young following.
Very loyal, very young, and also two big names in fast fashion here teaming up. I mean, Forever 21, known for its mall presence, Shein, known for its online presence, really playing on each other's strengths in this new partnership announced this morning. Of course, we do not know the financial details of the partnership. They were not disclosed, but once again, Forever 21, known for that mall presence, now will have its inventory on Shein's website. And one expert telling Yahoo Finance this will give the once bankrupt retailer a further reach, especially to those younger consumers who scroll through Shein, believe it or not, regularly. The more exposure will then ultimately help with Forever 21's volumes, and that's a critical strategy here in fast fashion. Now, the expert added that for Shein, this partnership is really what he said, icing on the cake. Shein, known for that online presence, will acquire 1/3 interest in Forever 21's owner, Spark Group. In addition to that, eventually aims to test customer-focused experiences in Forever 21 locations, similar to what it's doing now across the globe with the pop-ups they announced a few weeks prior that bring in long lines and lots of crowds. Now, Forever 21 products are also a little bit more expensive than Shein's very low-price products, and so this really helps to round out Shein's offerings. And in addition to that, this also comes as Shein is really expanding its offerings on its website and becoming more of a marketplace, similar to that of Amazon, experts telling Yahoo Finance. But both have similar audiences. Shein, as you can see here, has a reach of 150 million, and primarily that audience is lots of young female shoppers. Now, Shein's online presence and popularity has certainly skyrocketed in recent years, especially with that hashtag Shein Haul. On TikTok, hashtag Shein Haul has been viewed more than 12.3 billion times, and on Instagram, 744,000 times. Forever 21 Haul, not so trendy there. 81.2 million views on TikTok and only 1,000 roughly on Instagram. And in the background here, it's important to note that Spark Group has really been building up its portfolio with recent deals for Rockport, for Vince, as well as Hunter, which I know for their rain boots. But meanwhile, Shein, based in China, it's important to note here, has been under scrutiny, facing allegations by U.S. lawmakers for, violating U.S. import tariff laws, as well as forced and underpaid labor. Now, of course, Shein has denied those allegations. Shein has also denied planning to go public on the New York Stock Exchange. And so one expert telling Yahoo Finance that really perhaps this will take away some scrutiny on Shein here with this recently announced partnership. So lots more to come, and we'll be following all of it.
We will be following all of it. 150 million users for its app around the world.
Very popular.
Explosive growth. It's certainly been incredible to watch. We'll see what this deal does. All right, Brooke, thanks.
Well, we're taking a closer look at the state of retail today with two more companies getting hit following results this morning. Shares of both Petco and Dollar Tree under pressure, with Petco swinging to a loss and cutting guidance. Dollar Tree CEO, meanwhile, warned on the earnings call that the consumers are focusing their spending on food and necessities. Joining us now is Michael Lasser, UBS U.S. hardline and broadline and food retail analyst. Michael, good to talk to you today. Let's start with what we saw from Dollar Tree today, because that really seems to point to a trend that we've been hearing a lot of. Consumers going after more discounts or spending less in stores. They're also getting hit on the inventory side because of theft as well. Is there anything that emerged from their quarter that you think is specific to them, or are we starting to see sort of this broader trend, which is consumers are spending but being very selective in seeking out value?
I think it's the latter. This is an issue, a systemic issue really across the retail sector. The fact that Dollar Tree has a $125 price point across the majority items in the core of brand that it operates means it has less merchandising flexibility to deal with some of these challenges that have been facing the whole retail sector. Now, that being said, Dollar Tree generated as good traffic across both banners as anyone in retail so far, suggesting that what it is doing to attract incremental consumers is working. And eventually, as some of these pressures subside, that is going to lead to significant earnings growth over time. So we would use this pullback in Dollar Tree as an opportunity to accumulate the stock.
Michael, you just mentioned when some of these pressures subside, and I think everyone's trying to figure out how big of an issue theft is or how long that issue is going to last. We've heard a little bit more, Dollar Tree, one of the executives chiming in on what they're going to do to combat the theft. But how long do you see this being a significant issue across the industry?
So we expect that shrink across the industry will get better into next year. In the past, shrink has proven to be cyclical. When the consumer is a bit pressured, they tend to engage in more malicious acts like theft. Also, the retail sector has been through a tremendous amount of volatility between supply chain challenges, inflation, a very tight labor market, and all of those have contributed to the shrink issue in one way or another. Our view is that as the labor market starts to settle down, what's going to happen is retailers are going to have not an easier time attracting talent, but they're going to see less attrition. And that means that more of their workers are going to be tenured. More tenured workers should help stabilize the unexplained loss of inventory, which is what shrink is all about.
So it sounds like, Michael, you think that the shrink issue is largely stemming from sort of the economic conditions, that's sort of weighing on the market too. I mean, we had a guest on last week who said that it wasn't necessarily about that criminals were getting a lot more sophisticated, that they were able to sell some of these secondhand goods for a much higher price.
So there's no doubt that organized retail crime has been part of the issue. What I would tell you is that the Inform Act has recently gone into law, which is an effort by certain legislatures to try and stem this issue and lead to better enforcement. What it does is it makes high volume sellers of goods on third-party marketplaces having to identify themselves. That's going to create a disincentive to engage in some of these nefarious acts. And like I said, there's no doubt that organized retail crime has contributed to the challenge. But I don't want to leave you with the impression that that's been solely responsible for the challenge. There are other factors at play here.
So, Michael, when we talk about some of the catalysts that you see for the stock here going forward, what does that upside trajectory look like?
So we think as the company continues to generate sales momentum, over time, that's going to lead to better profitability. The company is front-end loading a lot of the investments in areas like wages, supply chain, and as it sees continued momentum, it won't need to make the same pace of investment that it has recently. The other thing to keep in mind is Dollar Tree was one of the hardest hit as ocean freight rates skyrocketed last year and the year before. And now that those rates have come down, Dollar Tree stands to see an outsized benefit from that fact. And we think that as we move into the second half of this year and really 2024, that'll become more evident in its financial performance.
So, Michael, when you look at the retail landscape, what's sort of the better place to put your money? Is it towards discount retailers, not just somebody like a Dollar Tree, but also like a TJX, where consumers are seeking out value? Or is it more of the traditional players who are diversified, like a Walmart?
I don't think it's an either or. I think you need to have some balance in your portfolio. So we like names like Dollar Tree, like Walmart, like Target, who do offer the discounting, that the compelling values to the consumer at this point. Now, with that being said, we would balance it out with names like Home Depot and Lowe's that eventually stand to gain as more discretionary spending improves and as interest rates come down. So our view is you got to have a balance between the more defensive type names in retail and the more offensive or cyclical names in retail.
Michael, you also cover Petco, which is under a tremendous amount of pressure today on the heels of their results before the bell this morning. We're looking at a massive loss here for today, I think off just over 20%. Some of the biggest headwinds facing Petco, you would think that it would be relatively well positioned given the fact that people continue to spend on their pets. But what's going on here?
So more than 30% of Petco's sales come from those more discretionary type purchases, apparel, toys, collars. And the profitability that Petco sees on those discretionary purchases is far greater than the profitability of pet food. And so the fact that those discretionary purchases are under pressure is translating to significant pressure on the profitability for this business. So until there's an improvement in the overall discretionary spending environment, Petco's going to probably experience lingering impacts from this. Now, it is more defensive because pets do need to eat. The pet owner is more likely to feed their pet at times than feed themselves. But until those discretionary sales improve, we think that the performance of this business is going to be pressured.
UBS's Michael Lasser, as always, it's good to have you on. Really appreciate the time.
After years of staunch opposition, Apple changing course on California's right to repair bill. The legislation will give people the ability to do more of their own repairs without a trip to the Genius Bar. Yahoo Finance's senior tech reporter Ali Garfinkel joins us now with more. And Ali, we were all a little bit taken aback by Apple's about face with this one.
There's no two ways about it, Shauna. This is definitely a sea change because remember how this all historically worked, right? I have an iPhone, for example, and historically when my iPhone broke, I hopefully still have Apple Care, and I really only have one option, and that's go to the Apple Store, go to the Genius Bar. And the reality is that's a really narrow funnel that has generated billions for Apple. Now, we don't know exactly how much Apple Care generates, but we do know that Apple Care is part of Apple's booming services business. Now, remember, that services business in February, revenue hit an all-time high of $20.8 billion. But I'd argue that this for Apple is even bigger than numbers, Shauna. Remember, limited repair options keep you inside the Apple ecosystem and really allow Apple to control this customer experience that is so, so important to them. However, they're now supporting this right to repair legislation in California. And so essentially what they're saying, for real in a full-throated way for the first time, is that we are ready to help you do it yourself. It's a massive change.
It is a massive change, and you have to wonder what the business case is for Apple's turnabout. I mean, what is that? And to what extent do you think California is setting the tone for other states to follow?
It's a good question, Akiko, and I will say that though this seems a little bit out of the blue, it's actually not as surprising at a second glance. For instance, there have been a lot of legal and cultural forces that have been pushing for this sort of change for some time. For instance, let's look at 2023 so far. 20 states have already filed right to repair legislation. It's sort of a rare bipartisan issue, and some of these laws have even already been passed. In Colorado, for instance, a right to repair law that focuses on software and ag tech is set to go into effect as soon as January 2024. Now, the other thing, too, is that there's a cultural movement here. It's called the Fix It movement. It's web-based, and it's about environmental awareness, reducing waste, and a sort of extreme DIY, saying, hey, I actually can repair my iPhone with none of the tools. The other thing, too, here, though, that's important is even though this looked like a massive change for Apple, in fact, they've actually been having a little give here and there for years, right? They've been making really small concessions as recently as the last 2 years, I would say. For instance, in 2021, they launched a self-service repair program. And in 2022, they actually did start offering customers the ability to replace their own batteries. So though Apple has ultimately given some input on this legislation in California, it's part of why they've agreed to it. I would say that consumer advocates are framing this as a mega win. And to me, when I see this, it shows that Apple has a little give sometimes.
Consumers excited still, though. I'm a bit surprised by this move. All right, Ali, thanks. Well, coming up, Autodesk shares pushing to the upside today on the back of a strong earnings report. Brian Zazi speaks to the CEO of the software maker when we come back.
Good morning. This is Yahoo Finance.
Big news. 3 things that you need to know.
We just got the announcement.
What happens now?
I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings, and they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there is more to come on this.
and we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again. Figure out where your money is going now. You got to scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
Software maker Autodesk topped second quarter earnings estimates. Let's get right into this quarter to break down these numbers with Autodesk CEO Andrew Anagnost. Andrew, good to see you here. Thanks for joining Yahoo Finance again. Talk to us about demand for your product. We're seeing and hearing a lot of companies warn about economic uncertainties. How did your quarter pan out in relation to expectations?
Well, so this is a great example of resilience, discipline, and opportunity, right? Resilience in our business, we're unusual in our sector in that we're a full subscription model company, okay? So that's really important. We're also diversified across everything that gets made in the world. And that's everything from cars to bridges to roads to rockets to factories to movies to games. We're participating in the entire world of designing and making things, which is super important. And everyone in that sector is committed to digital transformation. We've also been super disciplined during all these economic cycles we've seen over the last few years. We never overinvested where things were good to fund every project, and we never underinvested when things were bad to please every investor. And as a result, we're getting the rewards of that discipline. And if you look at the overall opportunity of what's going on in our industry segments, there is a fundamental hunger for digital transformation in our sectors because our sectors are suffering from a capacity problem. There's not enough labor, money, or materials to build or rebuild everything that needs to be made. They need digital transformation. So that's really the underpinning and the cornerstone of why we beat on all the metrics and why we were able to raise the low end of our guidance heading into the rest of the year.
Did the enterprise consumer spend more than you thought during the quarter?
Look, our biggest customers spent more during the quarter than we originally expected. And the reason for that is they actually were adding more capacity to use more of our products. And that's really important because what that says is they're bullish about their future. They used more than they expected in their last contract renewal. So they added more even ahead of their next contract renewal later in the year. And that is absolutely an important signal for our business.
We've talked to Autodesk in the past. We've talked to various executives in your team, and we always get the same question from the Yahoo Finance community. What does Autodesk do? And then more recently, we get the question, are you an AI play? I'm very curious on the latter part of that. Should you be considered with the likes of Nvidia?
Yeah, so first off, Autodesk helps people design and make anything. We touch the entire made world. And I said it earlier, I said it's everything from the Tesla that drives down the road to the bridge it drives over, the rocket that goes into space, the sets on Broadway, all of the things that you see every day, all the buildings you see, someone built it with our software. And what we're doing increasingly is we're aiding those companies to address increasingly complex challenges, regulatory challenges, built environment challenges, and integrating their design and make processes in the cloud, and yes, underpinned by AI. And here's what's important here. AI is not news to us. We introduced the concept of generative design almost a decade ago to our customers. We were bringing them tools that allowed them to explore multiple design options generated by a computer way early on. And we've been relentlessly looking at this throughout all of our efforts throughout all that time. And in our opinion, AI isn't upending everything. We're not going to try to automate creativity. What we're trying to do is increase productivity through what we call augmented design. And augmented design is helping people get the ideas out of their head and creating those really detailed and sophisticated representations in the computer that allow them to design and make it. So we're absolutely an AI player. We've always been an AI player. We've been quietly introducing AI-driven technologies into our products for a decade at least, and that pace is going to accelerate.
We've been hearing from a lot of really companies, Andrew, that play in AI about a lot of visibility into forward backlogs. In some cases, I remember I was talking to Cisco CEO Chuck Robbins recently. I mean, they have $500 million in orders related to their various AI initiatives. What does your demand cycle look like over the next 12 months?
Yeah, there is a huge backlog of demand. Look, there's a lot of sectors. We deal with a lot of sectors that haven't yet figured out how to fully deploy productivity to its full advantage. The AEC sector, architecture, engineering, construction, it's one of the most inefficient sectors in the world, in the global economy. And they have started to realize that technology, and now at the accelerating pace of AI, is going to have a significant impact on how they do their work. And they're scrambling to figure out, what should I do, how should I do it, and who should I partner with? And the vast majority of them are partnering with us on those types of transformations. And that's true across all the industries we serve. Manufacturing is trying to look at onshoring and reshoring and trying to balance high cost and low cost supply chains so that they're much more resilient in the future. That's resulting in a boom in factory building. Nobody has enough capacity to do this. They don't have enough capacity to build the factories and put all the things that are needed inside the factory. Now, we're seeing a few hiccups in media and entertainment right now with the writers and actors strike, but all of that's transient. Once they move past some of these issues, what you're going to see is they're going to be back to their usual problem of how do we produce more content faster and increase the quality of the content and increase the usefulness of the content.
Is that something you had to factor in? Is that something you had to factor into your outlook? The what's happening in the media space?
Remember, we're diversified across everything that's built, and media and entertainment is a relatively small piece of our business. But yeah, media and entertainment was a soft part of our business. It's to be expected, but there were lots of things that offset that softness.
There was a lot of discussion on the earnings call, Andrew, about your exposure to commercial real estate. You sounded like you were just tired of getting this question, but I have to ask you about your exposure to commercial real estate, and are you exposed to what's happening there, and is that a downside risk to your business?
The short answer is no. Now let's be clear here. Commercial real estate's heading into its own challenges, and there's a few things that they have to do to address their challenges. One, they have to reconfigure space to be more attractive to a shrinking pool of investors. And frankly, governments and commercial real estate owners have to partner more closely to lubricate the opportunities and frankly provide incentives for the opportunities to turn some of these spaces into multi-use spaces. That's a real challenge heading in there, and I don't want to be Pollyannish about that. But with regards to our business, remember, diversified across everything. So for everything that's going on in one sector, there's something exciting going on in another sector. Like I just talked about the factory boom. There's a factory building boom in the United States. And that boom is about a factory building. It's about the machines that go inside the factory. It's about laying out how that factory works and then managing that factory into the future. We touch every piece of that process. So even though one sector is seeing problems, we see increases in potential in other sectors. So in terms of our business, it's immaterial. In terms of that sector, they've got some problems they have to address, and there's ways to do that.
You're right, of course, Andrew. You have a lot of exposure to manufacturing, and you mentioned the boom. Has the Biden administration been friendly to companies like yours, companies that obviously are not building plants, but you sell into the rebirth of America? Because all of this, of course, is top of mind. We just had the first Republican presidential debate, and they were throwing out a lot of suggestions out there on how they might revive the economy. But how has this current administration been to a business like yours?
Yeah, so they've actually reached out to us and connected with us at various levels to ask our opinion about what's going to drive productivity in the built world. How do we continue to increase productivity in manufacturing and in construction? So we've actually had contacts with the administration. They are interested. One of the things that really excited us about the infrastructure bill was the couple of $100 million they put in there to help departments of transportation reimagine their infrastructure, their computer and their design and their making infrastructure, so that they could actually be more effective with the dollars that are being spent. That's the kind of partnership that helps us help the departments of transportation overcome the capacity challenge that they're seeing. So yeah, we have engaged, and they have been engaged.
Is there something else on the policy front that you would like to see, whether it's this administration stays in office or we get a new one from the Republican side, that can make your life easier as the CEO of a public company?
Look, I think it's really important that we continue to invest in resiliency across the board. that you continue to invest in helping manufacturers redistribute their supply chains, create more resilient supply chains, not just the cheapest value supply chains, but managing the mix of high cost near-shore supply chains or onshore supply chains with long offshore supply chains that generally cost less. We also have to provide incentives and tools that help people build back and rebuild existing infrastructure. Some of that stuff's out there. Infrastructure is a bipartisan thing. No matter who's in power, people like infrastructure, and they should. You see the extreme weather events we're getting. These are not going away. You're going to see water flooding places it wasn't flooding before. You're going to see wildfires in places they weren't before, and people are going to have to build more resiliently and more responsibly to these changing patterns. And that's something that government can play a really important role in. I think they are right now, and I think it's a bipartisan issue.
A lot of good points there. Let's leave it there for now. Autodesk CEO Andrew Adagnos, always good to see you. We'll talk to you soon.
Pleasure. Thank you.
Thank you. All right, lots more to come on Yahoo Finance. Do stick around.
And that's the closing bell on Wall Street. Let's do a check of the markets here. All three of the major averages closing well in the red. The Nasdaq off nearly 2%, certainly a drop in the markets today, being led by technology, communication services among the worst performing sectors. You're looking at the Dow off just about 1%. Boeing, Walgreens, Intel among the biggest decliners within the Dow, and S&P closing off nearly 1.5%. Really looking past the better than expected blowout report that we got from Nvidia. So let's take a look at some of those trending tickers, because shares of Nvidia closing the day higher, just barely though, up just about 0.1%. The stock had been up over 6% earlier in the trading session. The company posting another monster quarter driven by surging demand for AI chips. Net sales jumping 101% from a year ago to $13.5 billion. Akiko, certainly a massive quarter from Nvidia. The expectations were extremely high going into this report. Nvidia blowing past what the analysts were expecting, and a lot of them also very encouraged by what they heard from executives on the call.
Yeah, largely encouraged because there were concerns about Nvidia being able to keep up with demand, and executives making it clear that they are seeing outlook all the way into 2024, being able to supply to those suppliers. You talked about the blowout quarter that they had. It is also about the outlook. You're looking at projected third quarter sales at $16 billion, nearly triple the level from a year ago. So that tells you just how significant Nvidia sees this big boost coming through from AI. It's been interesting, as we noted at the top of the show, Shauna, to see how things have been playing out with other chip makers as well, who are trying to compete in that AI space because of what we've seen from Nvidia and because of the dominance of Nvidia. Some of those shares, including AMD, Qualcomm, and Intel, all seeing big declines on the day. Well, Nvidia's second quarter earnings surpassed analysts' already lofty expectations for the tech giant, but while Wall Street is hoping other chip makers jump deeper into AI, the question is Nvidia cornering the market. Yahoo Finance's Dan Halley joining us with more. Dan, it's worth noting this stat again, 90% of the GPU market, right? Specifically on AI. Nvidia already has it.
Yeah, it's going to be tough for companies to kind of overcome this. I mean, it's beyond a first mover advantage, right? When it comes to AI and Nvidia at this point, they're just dominating the market in a way that we haven't seen in a long time. I mean, you can think of Apple in the smartphone space. Even they don't have the market share that Nvidia has right now. And it really goes back to the investments that they made years ago. They were originally a gaming company, and then they opened up to developers and said, go nuts with what you can. And that led to the investments that they have now in AI. And, I remember years and years ago when they were going on about AI at a conference they were doing, I just kept thinking, man, just get to the gaming stuff. I want to hear about that. And lo and behold, this is absolutely paying off in the biggest way possible. I mean, you can look at Intel and AMD not having the best time of it. Intel especially, they've just been struggling mightily as they try to turn that ship around, build out their foundry business, working with other companies along the way. AMD, it is a competitor in the space, but it just can't touch what NVIDIA is doing. And I think part of that is because AMD is split between the two worlds. They do CPUs and GPUs, and yeah, you would think that that's good for them because it allows them to play in both spaces, but it also means that their attention is divided, whereas NVIDIA is all about GPUs, and they're putting all of their effort into that. The other big thing about NVIDIA is that they work the software behind the hardware. So they're full stack, soup to nuts. So that's how they have that advantage there. And part of the reason why Intel, AMD, we talk about Qualcomm, we can talk about ARM as much as those companies are talking about getting into AI as well. But it's the reason why they're able to hold off competitors at this point.
Yeah, Dan, certainly a massive first mover advantage, at least for now, when we talk about the fact that they account for nearly all of that market share and the demand simply that is there. There are, though, some risks here for NVIDIA potentially down the road. We've talked a little bit about supply, but what does that look like and what else should investors keep in mind?
Yeah, so that was something that came up on the earnings call with supply and China. The two things that people were really worried about was, can NVIDIA keep up with supply with TSMC and its other suppliers? Can they meet customer demand, which is just through the roof? And can they meet the expectations that they'll continue to provide products if there is an issue with China, if we see further sanctions against exporting from the U.S. to China? And basically, what the company's CFO had said was, there's no problem. Our suppliers are working well with us. They're ramping up. They're ramping up through this year and into the next. And they're also not going to experience any issues if there are additional sanctions against exporting to China. So right now, they're sitting pretty. I mean, you can't look at them and say, there's no problems. I'm sure that eventually supply will be an issue. But at this point, they're saying, look, up to 2024, we're pretty damn set.
All right, and again, stock up over 220% since the start of the year. Dan, thanks. Well, shares of Boeing flying lower today after the plane maker warned of a new manufacturing issue for its 737 MAX jets, and it could impact near-term deliveries. We're looking at the stock closing off nearly 5%. The company saying that fastener holes were improperly drilled on some of the model's jets here. Now, the parts were being evaluated, and they were made by Spirit Aerosystems, which also fell to the downside today. You're looking at a loss there of just over 12%. And Kiko, this all comes down to delivery numbers and how big of a setback this could be for Boeing. We know Boeing was aiming to deliver up to 450 MAX jets this year. Just another complication for a company that has faced a number of setbacks over the last couple of years.
Yeah, it does come down as yet another quality control issue in a number of manufacturing flaws that have emerged specifically within the MAX program. And to your point, certainly bad timing when you consider that Boeing's been trying to ramp up production, talking about increasing production from 31 to 38 a month. In terms of this specific issue, we had heard from Spirit Aerosystems, who said, look, we use multiple suppliers, so this particular problem is not really on all units across the board in the MAX planes, but nonetheless, you're looking at potential delays here, and that's why we are seeing both shares down significantly today in the session. Well, shares of Spirit Airlines closing the day in the red after the airline agreed to pay over $8 million to settle a class action lawsuit filed by passengers. Customers claiming that Spirit wrongly charged them with surprise carry-on bag fees on tickets bought through third-party travel services. And Shauna, this is a lawsuit that dates back to 2017. You're looking at the settlement here. Travelers who are eligible will get refunds under the deal, will get refunds of up to 75% of their fees back. But it does go back to a conversation I feel like we've been talking a lot about, which are these sort of junk fees, as the White House has framed it, sort of the hidden fees where customers don't necessarily have the transparency. And we're seeing more and more of that emerge.
Yeah, we've heard President Biden time and time again vowing to tackle those hidden fees. He said it a couple of times over the last several months. When you take into account what this could mean for Spirit, we know Spirit heavily relies on those fees, right? A lot of times their fares are so cheap, and so they upcharge some of their passengers for bags, things like that. Now, the argument, like you just said, in this case is that people simply were not aware when they were buying their tickets through third-party sites. And it also comes at a tough time for Spirit. The stock has been under some pressure recently. Earnings that were just out a couple of weeks ago fell short of the street's expectations. The company talking about softer than expected demand during the peak summer travel season. We talk about a lot how people have been focusing on those international trips. A lot of the airlines, a lot of their competitors have been talking about substantial demand and increase in demand for international. Obviously, that could hurt and does hurt a player like Spirit. They do expect, though, demand to normalize in the fall and into the winter months. So we'll see. But again, we're looking at some worry here from the street on the heels of this suit and the settlement here of just about $8 million. All right, well, still to come, shares of online mortgage lender Better off to a tough start after making its public debut today. We speak to the CFO on the other side.
We're watching shares of chipmaker Marvell Technology trading lower right now, down by 3% after reporting earnings. Let's kind of break down the numbers here. Looking at adjusted EPS, that was a beat of 33 cents versus the 32 cents that the street was expecting. We also beat on revenue, $1.34 billion versus $1.33 billion. Looking at where the company is guiding for Q3, we're looking at a range of 35 cents to 40 cents, and the consensus was at 40 cents. We should mention, Shauna, even though they did beat on revenue, that was a 12% decline when you look at the numbers year on year. Looking at where the shares are right now, it's worth noting Marvell shares were down significantly today on the back of those Nvidia earnings that we saw yesterday. A blowout quarter, of course, for that company. But Marvell, one of those big players we have been seeing on AI. They've talked about the big opportunity they see within this space. Seeing where the stock is right now, down a little, but it was down as much as 6%, I believe, Shauna, during the session here. So tough to get the read on that, but of course we'll be listening in on that conference call to see where they see that opportunity. A reminder, worth noting again, that we heard from the CEO, Matthew Murphy, in the last quarter saying that Marvell's overall AI revenue is going to at least double going into fiscal 2024, but certainly going to be a lot of questions about how on track they are on that space, because AI, once again, the big opportunity for this company.
A huge opportunity here for this company. Again, some concern because, like you just mentioned, the decline in year-over-year revenue. When you dig down a little bit deeper into that revenue number, data center revenue, that was just around $459.8 million for the quarter. That's off 29% on a year-over-year basis. Their consumer revenue, though, was up just about 2%. But like you said, a lot of pressure on Marvell's stock going into this report. Now we're seeing a further decline of just about 3% in extended trading. We'll see what we hear from the executives on the call. That's expected to get underway in just a bit. All right, well, office landlords seeing a rise in lease signings this year, but for less space. This according to recent data by CoStar Group. Let's bring in Yahoo Finance's Danny Romero to discuss the latest trend. Danny, what are we seeing?
Shauna, say sayonara to office amenities. The office space is shrinking. The average size of an office lease signed this year was about 3,200 square feet. That is lower by 19%. That's what CoStar reported. But there's good news for landlords. You still have tenants. More people are signing those leases in the second quarter, totaling to nearly 100 million square feet. That is higher than pre-pandemic levels. But another thing to notice is that tenants are signing these leases for a longer period of time, for over 15 years and more. So this data really reflects on how employers are adapting and embracing the hybrid model, allowing workers to work a few days a week in the office. And at the same time, the office vacancy rate is going to increase. We saw it. This is also another blow to the office demand and puts a lot of pressure to the value of these buildings. And experts say that office vacancy will likely increase, and CoStar expects that office vacancy will hit about 17% by the end of 2026.
So, Danny, as we look regionally, where are we seeing the biggest cuts in office footprint?
Akiko, you've heard of the phrase less is more. Well, that's what's really happening in the office space. A number of companies are shrinking their footprint, and businesses in Houston and also Austin, Texas are shrinking their footprint by about 70% because of the attendance. There's less attendance in the office. And also we have to factor in that a lot of businesses are changing their requirements when it comes to the days that they're required to come to the office. That's something that's weighing the market right now, but also a lot of businesses are becoming more modernized and they're allowing more flexibility, and technology has improved, which allows that flexibility to factor in. In Seattle, a company there said that they increased their workforce, but they also slimmed down their footprint because they changed up some of those office requirements as well. But again, something to think about is that some businesses are requiring workers to come into the office for more days, 5 days a week. So that could lend itself to some positivity in the office space. Akiko.
All right, Danny, we will see, because we know the office space has certainly been struggling now ever since the start of the pandemic. Danny, thanks.
Well, shares of online mortgage lender Better plummeting today after its public debut on the Nasdaq this morning. There you have it, down more than 90% in the session. The share price was $10 at the open. The public offering coming via SPAC merger with Aurora Acquisition Corp. The digital homeownership company offers mortgage and insurance services to prospective buyers. Their listing comes at a tough time for the housing market, though, plagued by high interest rates and low inventory. For more on this, we turn to Better President and CFO Kevin Ryan. Kevin, a tough debut by all accounts here when you're talking about your stock down more than 90%. What do you think happened? Was it mispriced?
Oh, Kiko, thank you for having me first and foremost. Look, I don't think we're going to talk about price or focus on price. I think if we just focus on the deal first, we struck this deal in May of 2021. It was clearly a much better time in the mortgage market. It was a much better time for SPACs. It was a much better time in the capital markets, much lower interest rates, better for fintech. So clearly, SPACs are different than traditional IPOs. We worked very hard on this deal. We announced it in May of 2021. We worked on it throughout the winter of 21, the spring of 21. We announced it in May. And we stuck with it. It took us a long time. It took us over 2.5 years to close this deal from really start to finish, but we stuck with it. And so for us, the most important thing is we're a mission-driven company. We're a digitally native company. And we think ultimately over time, and I just heard you talking about real estate, the real estate industry, like most consumer finance industries, is going to go digital and transform from the analog way real estate's been done. And so for us, we put $568 million of capital on our balance sheet at probably the worst possible time in the mortgage cycle. And so there's 4,000 mortgage lenders in the United States. If rates stay, higher for longer, and a lot of the talk out of Jackson Hole is higher for longer, I think a lot of those companies are going to struggle, and many may go out of existence. And we just shored up our balance sheet at a time where nobody really thought anybody in this sector could. So this is $568 million of cash, clearly at a 2021 valuation, and the stock is way down today. We're not surprised, but we're building long-term value for shareholders. And we're trying to, disrupt the consumer industry over time, and we think this is just the beginning.
Yeah, Kevin, I think a lot of people are asking why now, given all of the reasons that you just listed. Was it the only option? Or walk us through, I guess, how you evaluated why this still made a lot of sense for the company.
Sure. We thought about that a lot. As you would guess, over 2.5-year period, as we worked through with the SEC, as we worked through our investors, we thought about this a lot. Is this the best answer for the company? We raised $568 million of capital at minimum dilution to our shareholder. As a management team, our duty is a fiduciary duty to the shareholders to get the best deal possible. So were there other deals possible? Yes. Were any of as attractive as this deal on the economic terms of what it means for the corporation and the balance sheet? All of that cash is coming directly to the company. No shareholders are cashing out as part of the proceeds of this deal. We thought this was just simply the best answer. We raised convertible debt financing at roughly an $8 strike price. Stock's at $1, as you pointed out, and a 1% interest rate. The treasury rates are 5 times that now. So the terms of this deal were just so attractive that we decided to stick with it, have grit, and go after it, and we got it done.
So Kevin, let's sort of turn to what the medium-term outlook is. I mean, we've already established this is a very tough time for the market that you are competing in. I mean, what's your expectation right now as we look ahead to where rates are likely to go a year from now? I mean, we have heard multiple analysts come on and say, look, those rate cuts aren't coming, that we are going to remain at these levels for a long time. What does that mean for a business like Better?
Well, it means 2 things. I think it means that earnings could stay depressed for some time. If rates stay high, I think that's the reality for Better and for any company we compete with in this space. I think it means that the strong will get stronger. Because they actually have the capital to see it through the cycle. We've put ourselves in a position to be right there. One of the best 5 best capitalized mortgage companies, non-bank mortgage companies in the industry already overnight as a result of this deal. So I think it may mean you have more time to invest in the business. We're going to take some of the proceeds of this deal and we're going to reinvest in Tin Man, which is our homegrown digital offering. It's our homegrown technology that we built from ground up. We're going to invest in that. We'll invest a little bit in marketing. We're going to diversify the revenue stream of the business to take some, but clearly not all, the cyclicality out of the company. And we're going to do that over the next couple of years. So would we be positively correlated to lower rates? Of course. And if rates come down, we feel very well positioned to take advantage of that. We drove $58 billion of volume in 2021, and we only did $5 billion of volume in 2019. So we grew the company, from $5 billion to $58 billion in a year and a half. And if rates come down, we'll go after and do it again. And if rates stay up, we'll stay prudent. We'll be stewards of shareholders' capital. We'll reinvest back into business, and we'll be the best prepared for the other side.
Kevin, who's your core customer? Is it about the younger first-time home buyers that are, in your words, a little more digitally native? I mean, who are you going after?
Yeah, I mean, in general, yes. I mean, we have customers of all stripes. We skew a little bit younger. Not surprising. We're all digital. We skew, average home price approximately $400,000 to $500,000. Average loan $350,000 to $400,000. So we're here for all Americans. We built out a UK business as well, but we're here for people buying middle of the road average homes in the United States, and we're bringing it to them in a great customer experience at the lowest rates. We save customers an average 45 basis points versus the MBA average by doing it all digitally, having low overhead, no branches, etc. We're able to deliver very low rates to the customer in a digitally native offering. And so we're really targeting houses throughout the country. We don't do super wealthy, but we really target, consumers like you, like people that watch this show. I mean, retail Americans who are looking to get the best rate and a great experience. Mortgage is not known for a great customer experience. And what we're here for is to try to change that. And that's going to take time, but we feel like we're at the forefront of that.
Yeah, although it certainly feels like mortgage lenders looking for any business right now, especially in the tough environment. I mean, long-term goal, it does sound like you're all about sort of creating this one-stop shop for prospective home buyers. What does that experience look like ultimately?
Ultimately, it should be all digital. If you think about home ownership, particularly a purchase transaction, this is the single biggest financial transaction for 99% of all Americans. So for 99% of all Americans are never going to have a bigger investment than their own home. And so therefore, this is an extremely important transaction. There is very high correlation from taking out a mortgage to engaging in other financial transactions. The obvious one, homeowners insurance. Can't get a mortgage without homeowners insurance. That's obvious. Title insurance. Can't get a mortgage without going through title insurance. But think of other things. Life insurance. Oh, I never had a life insurance policy. I'm a homeowner now. I have a family. I just started a family. I should get life insurance. So there's a real opportunity at the point of sale to really deliver for our customers over time. So we started with real estate and mortgage. And honestly, mortgage is the single hardest thing to disrupt. It is the most regulated, arguably the most antiquated in the way we go about the process. I know if you've gotten a mortgage, but you had probably people at your house and notary sitting next to you. It is not a simple process, and all we're trying to do is break that down and help the consumer. And over time, that's going to drive a great customer experience via great technology, and we think drive shareholder value over time. Clearly, it's not the best time in the market, and we're seeing that. And rates are more than double where they were when we did this deal 2.5 years ago. We get it. We live it every morning and every afternoon and every evening. But all that being said, we think this is a long-term journey, and we put ourselves in a great position here.
Yeah, certainly a tough debut with the stock down more than 90%, but really appreciate you still joining us on the show. Better President and CFO Kevin Ryan.
Thank you for having me.
We've got some breaking news. Gap is out with its earnings report. You're looking at losses of just about 2% in extended trading. Another weak report here from Gap. Sales declines across all 4 of its brands. Overall, though, revenue coming in just below the street's expectations, $3.55 billion. The estimate was for $3.57 billion. Inventory might be the silver lining in this report. They did see bigger than expected declines as they look to get a better handle on their inventory. That was off 29% on a year-over-year basis. But Akiko, when you take a look at these brand declines here for sales, Old Navy sales there dropping 6% from a year ago. Gap sales also in the red. Banana Republic off 8%. Athleta, which Gap had really been relying on for some time now, declining sales once again here for this quarter for Athleta, off just about 7%. There's a new CEO at the helm of Gap. The pressure is on, and we'll hear from him on the earnings call later on tonight in just about a half an hour from now. But still, the reaction in shares off over 1.5%. There certainly are still some questions, some concerns when it comes to Gap, at least in the short term.
Yeah, Sean, I was going to say this is a company that has really struggled to find its footing, but I imagine that call earnings call in shortly will really be about where this company is headed. To your point, that new CEO coming in from Mattel, a lot of expectations riding that, especially given the success that he saw around the Barbie movie. So it's going to be interesting to see where that strategy is moving forward. There's a number of turnarounds in there with so many of those brands struggling, as you mentioned, but imagine most of this is going to be really very forward-looking to see where this company is headed after the struggles they have faced over the last several years with that stock down yet again on the back of those results.
Yeah, just over 1%. All right, well, coming up, we are going around the horn, checking in on some of the top trending stories of the day. Josh Schaefer, Ali Canal, they're standing by. What do you have, guys?
Hey, Shauna. Well, Warner Brothers Discovery is betting big on live news to bolster its streaming service.
And if you feel like you've heard that story before, you're not wrong. But up next, we're going to break down what's different from CNN Plus to this new platform, CNN Max.
Welcome back to Yahoo Finance Live. I'm Alexandra Canal, joined by Josh Schaefer and Praz Subramanian. Let's chat Warner Brothers Discovery, because some interesting news that we got this morning. The company really betting on live sports to bolster engagement on its flagship streaming service, Max. They announced a 24/7 news program called CNN Max, so really not getting too creative on the name there. But this is going to launch in the US on September 27th. It's going to be an open beta, so current subscribers can give their feedback on the service. And of course, this comes at a time where we're seeing linear network television decline across the board. But 1 year after the failure that was CNN Plus.
So it's sort of double-edged, right? Because you look at the failure that was CNN Plus and you think, why would you do this again? You think it's probably very similar to CNN Plus. Yes, you changed the name, but I was sort of asking you before, I was like, Allie, what's really that different here? And I wasn't entirely sure still necessarily what is fully different, and I think the consumer might feel that way just when they see it, right? You knew what CNN Plus was. You then have CNN Max. As a consumer, how do you really understand what the difference is there? I think they might struggle with that. But bringing news onto the platform certainly makes sense to me, just as far as you already have the content, you create a lot of news, you are CNN, why not leverage that on your streaming platform? Not every streamer has as popular of a news network as CNN, so it certainly makes sense to at least get it involved in the app more, Praz, to me.
I mean, my cynical take is, what is going on there, right? So we had this product, CNN Plus, it was live for like a week, then they canned it, cost a ton of money, laid people off. Then they relaunch another news product 24 hours a day on Max, online. What's going on here? And my take is, I've seen this before. I'm looking at you, ABC News, right? What's going on is new manager comes in, they want their own baby. They don't want someone else's.
Yeah, that's a good point.
They're like, you know what, we didn't make this thing.
Timing, I think, was a big factor in the CNN Plus debacle, because you had the merger close. And it's not lost on me that very soon after that, you know, Zucker
got fired, and then they had some. So it's like, this is what is happening. Is if you're a corporate player, you can play that game and figure out, oh, they don't like what they had before. Let's repitch it as something else. I don't know. It's really crazy.
It seems like timing might be on their side this time when you just think about the political cycle, right?
Oh,
and
absolutely.
You're starting to get primaries pick up. Like, this makes a lot of sense to be launching it in October.
And I think it's a new product.
Yeah. End of September, and you were just saying how it makes a lot of sense. And analysts that I've spoken with have also said it makes a lot of sense.
Sure.
News and sports, those are two things that have been called out as differentiating factors when we think about the streaming landscape and how you can keep consumers engaged on the platform. Engagement has been that key word in recent weeks and months that I'm hearing across the board. So it might not necessarily draw new subscribers, but it's going to keep you on that platform longer.
It puts you on the app, which is the same thing people say about sports, right? Is it gets you on the app.
And sports is something Warner Brothers is getting involved with as well.
And then you might see more original content that you're then interested in. It's why Amazon really wanted the NFL, right? To get more people literally on the Amazon Video app, because sometimes people aren't seeing the full breadth of what is there. And I think that that's an interesting part of it, to me at least, to just get you on the app.
Yeah,
then you can watch more.
And there seems to be a little more urgency here with the 24-hour news cycle, breaking news cycle. Before it was CNN Plus.
Everything's breaking news now.
Yeah, of course. But before CNN Plus, it felt a little lifestyle-y, like they were doing an Anderson Cooper parenting show. And to your point, the marketing of it was a bit confusing, and I think consumers were confused at the point. So I think they're going to have to do a better job of making
this
that
feels
known.
more on brand to CNN's brand to me.
Totally. And they're using, you know, like anchors, correspondents, reporters, those personalities that you're used to seeing as well.
Yeah. And I guess you haven't cut the cord yet. This might be a good option for you, right? Yes. So speaking of people who haven't cut the cord, maybe watching at home, a new report from Bankrate finds that guess what, people who sort of got a taste for it over the pandemic, they kind of like it, right? So according to the numbers, 64% of people like a fully remote environment, 68% like a hybrid environment. But guess what? Most people, 81%, want a 4-day work week, right?
I mean, so I would love a 4-day week. Guess not if the stock market closed on Fridays.
Yeah, and I'm not surprised this is the case, but I think it would be different if you said you can only pick one of each. I think if you can only pick one of the three, I would say that hybrid would probably win out. But if you're talking about 4-day work week, of course people want to have that. Plus maybe hybrid too.
But I don't want the 4-day work week, and here's where you're always curious, like sort of how the questions are phrased. Am I supposed to produce the same amount of work? Because then I really don't. I'm going to be honest.
No,
I don't want a 4-day work week.
You work more than 8 hours a day, don't you?
Right.
Right.
So then if you condense it, I'm still supposed to do the same amount of output, call it X amount of articles or X amount of things.
Yeah, sure.
Then
But
how are you going to do that in 4 days? You're going to work so many hours. It's not even going to make sense. You're not going to exist
You don't want
from
that.
Monday
You don't
to
want
Thursday.
that. You don't want that Friday every Friday
Oh,
off.
I would
I
rather
also
work
don't think you
until
can take.
8 p.m.
I don't think you can take 3 days off in a row and not be behind.
Who is this guy?
What do you mean? You just log off for 3 days?
Were you just creating a test tube somewhere from upper management?
No, I'm being honest. I'm being honest about how you work.
So what do you want to do? You
Like,
want to work 5 days a week? You know what? You should work at Goldman Sachs because David Solomon,
I don't want to work at all. I don't want to work at all like the rest of us, but you have to work. So at some point, I'd like to
David Solomon.
David Solomon, you're
He
David
would
Solomon's
love you.
ideal employee because he's taking away summer
God.
Fridays. He's saying everyone has to be in the office 5 days a week. The banks sort of set the standard at times.
Well, I didn't give my stance on hybrid work. I didn't say I wanted to be in the office every day.
Okay, so 5 days a week, but you're remote or?
A little bit of hybrid. I like the
little bit of
option.
hybrid.
Well, I like the option for
I like
every
the
now and
option
then.
too.
Every now and then you don't have to come in all the time, but I do personally value office collaboration.
So you're saying if they were like 4 days a week, don't have to work more, just 4 days a week. Obviously, you would take that, right?
Yeah.
But you're saying don't make me work more during those 4 days. That's your whole point.
I'm saying if there are 10 things, call it 10 things you have to do a week,
right?
And you now can only have 4 days to do them, that's a pretty stressful 4 days.
I don't know if I fully agree with that, but I do think I do think the pandemic has really changed how people approach work, how people approach even sick days. I mean, apparently today, August 24th, is the most called out day of the year, which feels so random to me.
It's the end of summer.
But
So weird.
but I've even noticed myself, I used to never take a sick day in my life. And then I had 104-degree fever in March for like 3 or 4 days. And I was like, you know what? I'm taking a sick day. I was very proud of myself for that.
You should.
I
You
think
should not
you
be
should have
coming in.
taken that day
You
off.
should not be
I
coming in.
needed to.
I think Pross and I are glad you took that day off.
So I don't take sick days.
If you're
he
sick,
wants
stay
to
home.
work 5 days a week. We're just a weird bunch here.
You
Pross
said-
is the only
yeah.
cool guy that like goes off to California for his assignments, hanging out with like the Rolls Royce like CEO. We gotta take a page out of
Take
Pross's
sick days every now and then. You know, it's what I do. It's what
I don't
do.
have a good
Real
transition
sick
for my
days.
story today out of this, to be honest. I want to talk about footwear. Because if you're coming in the office, you got to wear shoes, right?
Yes.
You gotta
And it's
be
been
good.
interesting. I've been following some of the different earnings calls we've seen from these sports retailers over the last couple of days. And we saw from Foot Lockers, obviously not doing well again this quarter. They're seeing some slowdown in particularly lower income consumers and that discretionary spend when it comes to shoes. Dick's reporting also a little bit of a slowdown in parts of footwear. But what's been strong at both of those brands and just keeps continually being strong is Nike and Jordan Brand. Jordan Brand continues to set records for how much it is selling. Pross, that collector's market still seems to be good. And I saw some news out today that it seems like Michael Jordan, as expected, is benefiting significantly from those shoes
making
being
the money.
sold a lot.
Yeah.
I mean, he's not just a billionaire. He's a 3.5 billionaire, right? I mean, he made a ton of money off that Charlotte Hornets sale.
He makes a reported $255 million every year from Nike.
From Jordan, yeah.
That is crazy.
And I think that's
the Jordan Brand itself does over $6 billion now in revenue.
Which is, I'm still shocked by. The guy hasn't played in 20 years, right? I know they have different athletes that they signed, but it's surprising to me like how popular that the resale market is. The reissuing of the old Jordans, still a big deal. Whoever's running their strategy, like of grand releases and limited releases, like just doling that out in the right amount of times, like perfect. And Jordan is
it comes as so many places are having to promo too, right? When you read through a lot of these earnings calls,
Are they
it's been highly
discounting the
promotional.
Jordans?
I've never seen Jordans on sale.
Every now and then, yes. I do.
Rarely, yeah.
Right. I try and go online and just see what's on sale and stuff when we're talking about these shoe things. And every now and then you do see, like this summer, they did a little bit of a sale on some of the Jordans, but not the Jordan shoe drops that they're doing.
Are the inventory
expensive
gluts
Jordans.
like not like is Jordan just always selling out? Because I know inventory is a
Jordan's
big problem.
the Jordan shoe drops are selling out.
And they make like
Wow.
they make like Jordan like workout shoes, so it's not like the Jordans that he would wear. Those are kind of always discounted, but it's the one like the actual basketball, the Jordans and the original colors, the colorways that come out, those are never on sale.
Interesting.
Never.
I'm not really a sneakerhead, but I know
I
the
know.
market's
Pross and I
there.
both have Jordans and we didn't wear them today.
Guys,
Not fitting.
heck?
Pross wears New Balances. Maybe they'll take over Jordan next.
All right, well, you have to tap in your Jordans. We're going to tap through the rest of this show. Coming up, we have much more on Yahoo Finance. Stay tuned. We'll be back.
New Balances.
Watching shares of Gap and Nordstrom, both retailers out with their second quarter results. Shares of both companies actually moving to the upside here in extended trading. Gap up just about 3%. We want to bring in Morningstar equity analyst David Swartz. And David, real quick, let's just recap the numbers that we got here. So Gap sales missed, total comp sales coming in worse than expected, a drop of 6%. Same store sales there dropping across all four brands. And then you also take a look at Nordstrom, a bit of a different picture there. Better than expected earnings, revenue, same store sales were also higher than what the street was looking for. We are starting to see some strength in Racket's off-price store. The decline there smaller than what the street was looking for. David, though, let's start with Gap, since that was really the focal point after hours here. We have a new CEO at the helm. What do you think of this report and how this sets up the new CEO, Richard Dixon, here as he tries to get Gap back on the right track?
He definitely has a lot of work to do. These sales numbers for Gap are quite poor. It looks like the EPS was above expectations due to lower costs. Gap has done a lot of cost cutting, a lot of layoffs, and that is helping the bottom line. But the reality is that all of Gap's concepts are really struggling with the top line, and a negative 6% comp for Old Navy is really bad. And unfortunately, Old Navy has been reporting negative same-store sales numbers now for the last couple of years, and it doesn't seem to be getting much better. So the new CEO who comes in from Mattel certainly has a lot of work to do there.
Where does he start? I mean, we just showed those numbers across all the brands that Gap has. What do you prioritize? Because all these brands have struggled.
The priorities have to be Old Navy and Athleta, because those really have the most potential. Old Navy should be doing a lot better than it is. In the press release, Gap called out poor activewear sales at Old Navy, and that's just really hard to understand because activewear has slowed down, but it's still a relatively strong category. And since Old Navy sells a lot of really basic stuff at low prices, it should be doing a lot better in this economy. And then if you look at Athleta, it does have potential because women's athleisure is still a very hot area. But Athleta has been underperforming a lot of other retailers that sell women's activewear, certainly Lululemon, but others too, like Free People Movement, which is owned by Urban Outfitters. Those really have to be the two main priorities for the company.
David, what does the timeline look like for this turnaround? We talk about what he needs to do to revive it. How long is something like that potentially going to take?
Well, it's already taken years. That's the reality. And unfortunately, I don't know if Gap can really wait, a long time for some of these new things to happen. Gap hasn't really been standing still. Now, it was without a CEO for an entire year, but the board did make some changes. I mentioned the layoffs. They have a new person in charge of Old Navy now. He was brought in last year. So they have made some moves. Hopefully, those will start to show some payoff soon. In the meantime, unfortunately, it's really just to try to stabilize the earnings. But the new CEO, Dixon, he has a background in apparel, and he comes from Mattel, where he had success with Barbie. He's certainly going to have to implement something new at Old Navy and Athleta, especially, to get them back on track.
David, let's talk about what we got from Nordstrom. On the one hand, maybe better than expected, but sales in the department store are still below pre-pandemic levels. You look at where Nordstrom Rack is, that also saw a decline, although not as much as the street expected. I mean, what does it tell you about the mix that Nordstrom has right now? Is it about inventory? Is it about pricing? What are they not quite getting right?
Nordstrom certainly does have merchandising problems. It can't seem to do very well with Gap and the full line stores at the same time. It seems like one of them is always struggling. In this quarter, it looks like Rack had a better quarter than expected, but the Nordstrom full-size stores did not have a great number at all. The overall sales are a little bit better than I expected, but it's really just because expectations are so low because Nordstrom has been struggling. As with Gap, Nordstrom has been cutting expenses. They did show some improvement in the gross margin in this quarter, which does bode well perhaps for better profitability. But again, like Gap, there really needs to be top-line growth at Nordstrom, and we haven't been getting that recently, even with the anniversary sale coming in July this year.
David, why don't you think RAC has been doing well, especially given this environment? You would think even people at the higher end of the spectrum are starting to trade down. They're looking for those deals. You would think it would set up RAC to have a better quarter than another quarter of sales declines.
I think the big problem with RAC is that Nordstrom doesn't seem to know what to do with it. It seems like every quarter we hear a different story about what RAC's place is in discount retail and its place at Nordstrom. At one time, Nordstrom talked about having higher price merchandise at Gap, at RAC. Other times they've said we should have lower price merchandise at RAC. So it's kind of all over the place. It seems like the company doesn't really know what to do with it. It certainly should be performing better. And Nordstrom continues to open a lot of RAC stores. So Nordstrom certainly believes it's going to turn around soon. We haven't seen it so much in numbers, but this quarter was a little bit better, it looks like.
Yeah, I think they've opened 9 new stores since the start of the year. All right, David Swartz of Morningstar, thanks.
Thanks.
Well, coming up, it's closing time here on Yahoo Finance. We're going to recap the top stories of the day and get you set for everything you need to know tomorrow. Stay tuned. Let's take a look at a couple of names that are trending after hours. We got 4 stocks for you. Let's start off with Gap. We were looking at gains of just about 0.7%. Not a huge move here in extended trading. It's actually a bit surprising given the results that we just got from Gap. The company reporting a larger than expected drop in same-store sales. Revenue also missing expectations. Total comp sales declining 6%, which was worse than expected. All 4 brands for the company, posting a decline in same-store sales from a year ago. They have the new CEO, Richard Dixon. He is going to be on the call this afternoon. Certainly has a tough couple of months ahead as he looks to right the retailer. But shares of Gap, again, moving. Let's take a look at Gap, not Dow. Shares of Gap up just about 25% over the last 3 months. Year to date, though, we're still looking at declines of about 15%. Moving on to Nordstrom, another reading here on the retail sector. Better than expected earnings, revenue, and same-store sales, yet we're still seeing declines. When we take a look at some of the numbers that we're getting, Rack was one of the bright spots, I guess you could call it that, in this report. The decline in sales wasn't as bad as what the street was anticipating. Rack posting a sales drop of just about 4.1% for the quarter. That's an improvement from an 11% drop the previous quarter. Year to date, Nordstrom barely in the green, up just about 4%. When you take a look at the movement over the last 3 months, pretty similar here on that performance. Lots of questions about what the future looks like for Nordstrom and where the company should focus as it tries to get more consumers through its stores. And Marvell Technology, another read on AI and the excitement that we're seeing there. Certainly a lot was riding on this report. We're looking at losses of just about 3%. Now, the company's adjusted EPS beat the street's expectations. Net revenue also topped what the street was looking for at $1.34 billion, but it was a decline of about 12% year over year. Data center revenue was off 29% year over year. There's certainly been a lot of growing optimism within Marvell because of their AI exposure. Year to date, we're looking at gains of just about 54%. I'm rounding it out with Ulta, another reading on the consumer. Year-to-date drop of nearly 10%. After hours, though, we're looking at a gain of just about 2%. The company boosting its earnings forecast for the year as well as its comp sales forecast. They're expecting growth of 4.5% to 5.5%. So consumers are still spending a bit when it comes to beauty. Year-to-date, though, like I said, shares are still in the red.
What is closing time here at Yahoo Finance? Let's look at some of the top stories of the day. Mortgage rates surging to a 22-year high. The 30-year fixed sits at 7.23%, according to the latest numbers from Freddie Mac. The rate environment is a huge hurdle for many home buyers who are also facing low inventory. Meanwhile, online mortgage lender Better made its public debut on the Nasdaq today. Headwinds from a tight housing market, though, weighed on the stock in a big way. Shares were priced at $10 at the open, fell more than 90% by the close. We spoke to CFO Kevin Ryan, who told us doing this SPAC deal made the most sense for its shareholders, especially since it's been 2 years in the making. The deal brought in more than $560 million for the company. Also, ahead of Fed Chair Jerome Powell's speech tomorrow in Jackson Hole, Boston Fed Reserve President Susan Collins spoke to Yahoo Finance, saying that more rate hikes may be needed to cool inflation. She went on to say the Fed may need to keep rates elevated for a substantial amount of time.
Well, here's what to watch on Friday. All eyes on Jackson Hole tomorrow as Fed Chair Jerome Powell steps up to the podium for his highly anticipated speech on the economy. Investors will be listening for any clues on where interest rates could be headed. And here on Yahoo Finance, we will have plenty of reaction to Powell's speech, plus more insight into the global economy from former Kansas City Fed President Esther George and former Fed Vice Chairman Alan Blinder. We'll also get a read on the consumer here with consumer sentiment for the month of August. It comes as we've heard some mixed results from retailers, especially as many have warned about slowing spending. And investors are watching AMC, the stock down 26% today after the theater chain concluded a 10-for-1 reverse stock split today. And on Friday, AMC's preferred equity units will convert to common stock. The two moves ultimately mean that someone who owns one share of APE, the preferred equity units, will now only own a tenth of a single AMC share. AMC CEO Adam Aron saying that the move will allow the company to raise additional equity capital. And finally, if you have a Facebook account, you may be able to get a payout here as part of the Cambridge Analytica scandal settlement, but you will have to act fast. Tomorrow is the deadline for anyone in the U.S. to file a claim after Facebook was accused of sharing users' data without their consent 5 years ago. That does it for us today on Yahoo Finance. We'll see you right back here again tomorrow. Have a good night.